Of Econoday Unplugged. It's Tuesday, 15th of September 2020. As ever, Mark Pender is across the pond stateside, and I'm Jeremy Hawkins in London. The Forex markets are back in focus again, with both the European Central Bank and the Bank of Canada unusually making mention of the strength of their respective local currencies at otherwise fairly unremarkable policy meetings last week. At the same time, the not-so-great British pound was getting hammered as investors reacted to the latest UK government proposal on Brexit, which, if passed by Parliament, even the Johnson administration itself has acknowledged would break international law. Now, the current strength of the euro and the Canadian dollar is as much as anything else a reflection of US dollar weakness. So, Mark, since we have an FOMC meeting about to kick off tomorrow, how will have anything to say about the state of the greenback? Indeed, do you think they will a lower dollar as a means of helping growth and boosting inflation?
No, they will not. They will not mention. You're talking about Jerome Powell.
Yeah.
Tomorrow? No, it's going to be a non-answer. The question is certain to be posed, and the answer is certain to be a complete sidestep. So, their affectation is that currency, the strength of the dollar, the weakness of the dollar is of no matter in their deliberations. In any case, as you say, the weakness is playing in to their hands anyway, which is try to stimulate the U.S. economy, which needs it. And so I would say that that is an absolutely sure thing. I don't know what exactly news can be made tomorrow. The Fed is completely has opened the floodgates to the maximum degree, and with the average inflation,
yield curve control.
Well, they could talk about that, but that would be in something that we're looking into. And there, some of the commentary from Fed officials are that it hasn't really worked when it's been applied in a reliable way. So, I mean, they might talk about that, but I don't think that would be a significant policy issue. Even if they did say, there's positive feedback among the members, something like that, he might say. If he did, I'm not sure what that would do for the markets. As I was saying, the inflation averaging is the big event between the last meeting in July, and Powell might give us some details on how much overinflation, 2% they might tolerate for how long of a period. Maybe that might come into the conversation, and that could move the markets perhaps. But
question on that, I mean, do you think this I guess your answer is going to be no, but this switch to the average inflation targeting, do you think there have any implications for how they present the updated economic forecasts, or is it neither here nor there?
I wouldn't think that unless the implication is lower rates and more QE for a longer period of time, that could increase their forecasts for GDP and perhaps inflation. I'm not sure it would have that much of a bearing. The quarterly forecasts aren't due in this meeting here in any case, but that is something to look for, to start seeing if there is a creeping higher in the long range inflation forecast. I guess that would be a possibility, definitely.
Okay. Just sticking with this dollar tack for the moment. When I was growing up many moons ago, one reason why you used to have a weak dollar, this is going back to sort of the 80s, almost 90s type period, was everyone used to say, well, you've got the twin deficit. So you've got an expanding current account deficit on one side, you've got a growing public sector deficit, government deficit on the other. A plus B equals got to be bad news for the dollar. Has the Fed got any such worries, not so much with regards to the dollar per se, but the way these imbalances are steadily growing?
I'm not even sure it's been brushed under the carpet. I guess it's just faded into unimportance given the need to immediately stimulate the economy. But the deficits are enormous. The trade deficit is, a persistent post-World War II feature of the U.S. economy. But the exploding fiscal deficit, which has been another feature of the U.S. economy. It has just taken off dramatically, over $3 trillion going into with 1 month left on their on the government fiscal year. But no, that has not been a topic of prudence. Prudence hasn't been one of the things that is really discussed. It's it's like almost Powell saying, I'm not even thinking about lowering rates. And
Yeah.
and they want more fiscal stimulus. The central bankers have been calling for it. They're desperate, really, because they're out of their own tools. And part of the story for the U.S. central bank in the second half of this of this enormous year is to find help somewhere else. And getting back to the dollar, if they can get a little help from that, and certainly U.S. trade needs it, then I think so be it. And certainly importing a little inflation wouldn't hurt either. But we did get to, it's funny I should say that, we did get export prices today here in the U.S. and they showed a little life, not too much. It's really kind of, I'm looking at these inflation numbers and they just seem to be moving along basically where oil is really your guide. It's been improving and that's been lifting everything up, but it's still weak. So I mean, inflation is still underwater, or it's still below the 2%, sizably below the Fed's 2% goal, our initial target. I'm not sure what we should call that anymore, or long range target. But is it going to continue to rise? I don't know. I mean, I think really the final gist of tomorrow's meeting, FOMC, will be how COVID, or how the contagion, the pandemic is unfolding. If it's unfolding favorably, that'll be a plus. And if it's not, the Fed is kind of held hostage.
Okay, fair enough. Oh, before we leave the US, I suppose I should also ask you. So you mentioned it before in your spiel, but how is this fiscal package going through Congress? Is there going to be one, or is it going to be so small it doesn't make much difference anyway?
Well, I think the latter could be true, but the last I read is that it is in desperate straits. So it doesn't look like there's going to be a confirmation or an agreement or a coming together especially during the next couple of months of the election. And what does that mean for the U.S. economy? It's not good. I mean, we had industrial production today, and the U.S. industrial production for August, and it's still it's dramatically slowing in its recovery, and it is still almost 10% below where it was in February. So, and if at this rate of recovery, it's going to be well into next year at a roughly 1% rate of recovery per month now. That's not very much. I mean, we were 20%. If you remember.
Sure. Yeah.
Now it's slowed fast, like kind of not as dramatically. That's more dramatic than I think the slowing we've seen in U.S. employment, but still. Oh, I have a question now about you. Now, we had a U.K. employment, and we were talking before we were emailing before our talk here, and you had mentioned that the employment report is not the most important indicator. I think that's what you said, that not the most important indicator in the UK. Now, for me, that's a little bit mysterious because, for the Fed, employment is their number one thing. So, so is the Bank of England, is employment their number one thing? And if it's not their number one thing, what do they look at for employment to see if their policy is working?
Okay, well, of course, the Bank of England's remit, indeed, and the same as the ECB, and you can sort of really put them in, I suppose, in the same bracket on this one, is to hit some kind of an inflation target. So 2% for the Bank of England and just shy of 2% for the ECB. Now, that's meant that by and large, they've been concentrating very much upon those indicators they regard to be giving them the best information about inflation trends. Now, that's not to say that either central bank has just completely ignored the employment or unemployment data, whichever you want to look at it, in the past. But it has tended to mean they've looked at more things to do with demand, so particularly from what's going on with the likes of retail sales, or from supply side in terms of the likes of industrial production, and crucially in more recent years the likes of the PMI survey. And that's why I think when you look at, for example, when you go across to the Eurozone, we get a monthly labour market report. Very little attention is paid to that. I mean, it comes out, it's quite late anyway. It's a couple of months or so out of date by the time we actually get the thing. But markets, by and large, tend to ignore it. For the UK, you tend to get more detail in that report. And so it's not really so much in the past, it's been the labour market data in terms of what's going on with employment or what's going on with unemployment or even vacancies. The focus has tended to be what's been happening to wages growth, because wages directly feed into what's going on with inflation. However, I think because now when you look at most of the commentary coming out of both the ECB, but in particular the Bank of England, they are now clearly, although strictly speaking, it's still target inflation, 2% or close to 2%. What they're most concerned about is what's going on in the real economy. And for the bank, as it made clear in its August Monetary Policy Committee meeting, is now attaching more weight than ever to the unemployment rate as some kind of measure of how much spare capacity is left in the UK economy. And clearly the more spare capacity you have, potentially even the less upside pressure or indeed more downside pressure you have in terms of the absolute price level. So I think as we go into Thursday, you will see in the bank's official communique a lot of talk about what's going on in the labour market. And it's meant that the unemployment rate for the UK now, and this really is the ILO, the International Labour Organization, their definition. So in the UK, it still only stands at 4.1%. That's going to get increasing focus, and it's going to get increasing focus even more because, as we talked about on previous podcasts, what's going to happen to the so-called job retention scheme, this furloughing program that the government's been operating both in the UK and across the water on the continental Europe, which has been helping to keep down the level of unemployment and hence the jobless rates. For the UK, it started to be phased out at the beginning of this month, but doesn't disappear altogether as currently scheduled until the end of October. So the current data are still unemployment is being massaged down by these schemes. But once we get through October, unless they come out and change the furloughing scheme, so they extend it in some shape or form, and have been called to at least some kind of targeted version of the furlough scheme to be introduced once we get properly into the fourth quarter, then we're going to see these unemployment rates probably climb significantly, and that is going to have important implications, I think, for Bank of England policy.
Well, let's talk about the UK labor market report. So how should we read it? We see the claimant count unemployment rate, which is for that was for August.
Yep.
And that, I'm just looking at a graph here now, that spiked up, about doubled from the 4% to the high double digits during the crisis. Now, but the ILO, which is here for July, and I guess that's a moving average, but still it's 4 or 5, 6 months after the crisis, and it's still not moving. I mean, how can we read that? It's dead flat at about.
Well, it is. It is. The problem with in the old days, it used to be markets focused upon the claimant count, because as you mentioned, it's more up to date. So today's figure we had on the claimant count was 7.6% up from 7.4%. That is for August, and it's about as up to date as you're going to get on the UK employment market or unemployment market. But for the ILO figures, as you mentioned, it's a 3-month moving average. So in this case, we have the 3 months, not even to August, there's only 3 months to July. So really it's quite well out of date. And that period will very much reflect these furloughing schemes. But the problem with the claimant count is that they've made some changes to the definition, whereby claimant count unemployment is no longer regarded as an official national statistic. They call it an experimental statistic to be looked at alongside all the other indicators we get on the labour market. But of course, for financial markets, they still want to know the latest figures. So although most of the talk still tends to centre around the lagging ILO measure, people do look at what's going on with the claimant count, even if you can't trust it fully, and you certainly can't compare some of the numbers we have now with sort of a time series from a few years ago. But the latest trend, people will still try to determine what's going on with the claimant figures. But the bottom line to it is it's quite a messy report now to try and to interpret. And because you've got these current support schemes helping to depress the numbers, the headline unemployment numbers, it's going to be really interesting to see what happens once we get the other side of October, if indeed they haven't actually changed the scheme by then.
Let's turn back to central bank policy. For the Fed, and their genuine efforts over the last generation for transparency, and I say they open with employment. It's not inflation, or it's not. Their most concern is not only employment. Their opening concern consistently over the last half dozen years has been lower income employment. That's how they open up their conversations. So that's specifically what they're looking at. They're trying to. In order to do that, though, you need to have an identifiable, easily analyzed employment report that everyone can get a handle on, good, bad, faster, slower, that everyone can get involved in understanding where the central bank policy is going to go. So I guess the question I have then in Europe, when does labor, when Christine Lagarde has a conversation, when does labor pop in? Is it a few sentences down or what?
Yeah, it's normally we tend to get some way into the official statement because the opening paragraphs will typically be talking about what's been going on in terms of inflation developments. And then, of course, everyone seems to have forgotten about it these days, strictly speaking, the ECB, it targets inflation, but it keeps an eye on what's going on the monetary developments as well. It used to have an official target for M3, which gradually over time got downgraded to a reference rate, as they call it now. But it tends to be they go through that and then they start moving into the real economy world. So when we had Lagarde's press statement, a press conference, I should say, last week, you tend to get the preamble first mainly about what's happening to inflation and whether policy's working or not and what's going on in the financial markets. And she'd been talking for a fair while before she actually got round to updating their quarterly economic forecasts. So I think, compared to the Fed, because the Fed's remit is somewhat different, isn't it? You've got employment or unemployment kind of directly mentioned in terms of what the Fed is trying to achieve. You don't have that for the UK. You don't have that for the ECB. The whole thing, as it currently stands, and of course the ECB is undertaking a review at the moment, but the whole thing's written in terms of inflation. Hence, they tend to do that bit first and then sort of segue into how the rest of the economy is performing later on.
Well, interesting. If this crisis doesn't test that, looking at the ILO UK employment rate, there's been no effect from the crisis, but there certainly has been in the US. And if there is, and ends up, and your concern in your writing is that there's a significant risk that as these schemes, support schemes roll off, there's a significant risk that unemployment is going to climb. And I guess the ECB and the BOE have been lucky not to have, been in a phase of a catastrophic. We had a catastrophic loss of jobs temporarily, but still 15 million people still out of work. That's a lot of people. So that might test their patience. How about the reporters? What's the first question they ask?
Well, I think at the moment, the first question on most of the media's lips currently is what's going to happen to the furlough scheme. Because you mentioned, really, just going back to what we were talking about earlier, the key reason why unemployment in Europe is, I'm not sure if low is the right word, but let's say as low as it is because it's been supported by government schemes. Now, some countries like Germany and France have already announced that in some shape or form, their particular national furlough schemes will be extended going into next year or even beyond that. The UK's furlough scheme, though, is still scheduled to end at the end of October. And this is the question. I think there's been so much talk coming out of industry, be it the retail side, the industrial side, you can name almost any company you want, warning that once the furlough scheme is taken away, they are simply going to have to let staff go. So there's serious worries about a wall of unemployment, which is just hiding around the corner. So for the media, it's a case not so much of the Bank of England, it's directed at the government saying, well, look, are you going to extend the furlough scheme? Because otherwise, we're going to see, real problems. So I think, for the Bank of England, they are quite clearly hoping that we will get some kind of extension of the furlough scheme for a lot of members, I think. But I should say that the Andrew Bailey, the Bank of England governor, came out, was it 2 or 3 weeks ago now, I think it was, giving the nod of approval to the Chancellor when he reaffirmed that this furlough scheme will be ended. So I think, the bottom line is if we do see the furlough scheme ended as currently planned, then it's extremely likely that we'll see monetary policy in some shape or form in the UK being eased again. And that then is going to raise the possibility at least of interest rates going negative. At the moment, the talk coming out of the bank is that they're still looking into the relative virtues of taking interest rates down even further. Bank rate in the UK, so the benchmark interest rate, currently stands at just 0.10%. It's never been into negative territory before. And it seems that from some of the research papers and stuff they put out, there's this kind of sense that at the moment, if they came out and reduced interest rates still further, the hit to bank profitability and the efficient workings of financial markets would be more than a negative than any kind of plus you might get in terms of stimulating the real economy. So I think for the moment, although it's not a done deal, negative interest rates in the UK are off the table. But again, if it's the case the furlough scheme isn't extended and the economy falls off a cliff, then the bank presumably is going to feel obliged to do something.
Do the bankers there, the central bankers, actively call like they do here for this is under the umbrella of fiscal stimulus, the labor support? Do they directly call? So they're basically saying, here, look, we've done all we can, and we need help, and and keep, and more and more and more.
I think the more vocal is the ECB. I mean, if we can go back to the days of Mario Draghi before Christine Lagarde took over the number one spot, and it reached the stage whereby written into every communique, the press statement, was the fact that it's hugely important for those governments with basically small fiscal deficits or even a fiscal surplus, so with room to come out and reflate fiscal policy, should do so. Now, that was particularly aimed at the likes of Germany, obviously the main powerhouse within the Eurozone. And that became written into the statement, not necessarily quite the same wording every month or every other month, but to all intents and purposes, it was sending out the same message. And Lagarde, again, last week during her statement, was very much, battling away. She daren't. I think she's very loath to come out and say, well, monetary policy can't do anything more, because then you're giving yourself a real problem. But she will try and say it's hugely important that the fiscal side is helping the monetary side. So yes, within the Eurozone, you get that a lot. Within the UK, I think there's probably more talk between the Bank of England and what's happening with the government, to the extent that one of the big sort of stimulus packages we had coming through during the earlier days of the coronavirus, we saw the bank and the Treasury announcing various policy measures at the same time. And the coordinated impact there, I think, upon financial markets was, if you like, much more successful than some of the ad hoc announcements we've had coming out of individual national governments within the Eurozone at one time, and then the ECB at another time. So I think the idea of policy cooperation and coordination, it certainly sends a much more positive signal to investors and financial markets in general.
Speaking of cooperation, last week you were talking about Europe and its commitment to the recovery plan and Hungary's opposition. What's the latest?
Well, as I understand at the moment, I think they're still talking about it. So this rescue plan is still at the moment in a bit of a logjam. I think it's being voted on by a number of national parliaments, but certainly haven't all done it yet. But of course, until and unless the Hungary is prepared to give it the nod, then it doesn't matter anyway. And I think that's why we've seen within the last 2 to 3 weeks, Germany's come out and announced its own another several billion fiscal reflation plan. Macron out of France, President Macron came out about 2-3 weeks ago now and announced a 100 billion euro rescue plan on top of the best part of 200 billion or so the French have already spent. So individual national governments in Europe are still basically having to do their own thing, because it's still proving far too difficult to get all the individual countries acting as one when it comes to putting together a united policy front. Talking of united policy fronts and whatever, I suppose I have to mention the latest on the Brexit side, which is turning to be something of a complete disaster at the moment. I mean, for a lot of last year and before that, we're talking about the impact of Brexit upon the pound and how basically what came out of Brexit determined the pound. Well, the latest twist here is, for people who haven't seen it, is that Boris Johnson and co in the UK government have decided to introduce what they call an internal market bill, which we refer to as IBM, nothing to do with the company. Now, this effectively seeks to nullify some of the key elements in the Brexit withdrawal agreement. So this is the international treaty that Boris Johnson himself signed off on last October.
But it was never implemented into law. Was it?
Yes, that put it into law.
It was.
This is the key part. So this is the actual
so
Brexit.
He's on the record saying he wants to break the law, or
well, of course, it comes down to, some people may semantics, but for the law cognoscenti amongst us, it really is quite important. So the bottom line to this is that he's maintaining, which I think strictly speaking is kind of true, that UK sovereignty over UK law is paramount. And he wants to make some changes to the so-called Northern Ireland Protocol. Essentially, this covers trading goods between Northern Ireland and the rest of the United Kingdom, or Great Britain, I suppose I should call it. Because the problem is, going back to, and we talked about this so many times in the past, is that Northern Ireland is no longer part of the European Union, whereas Southern Ireland is. And the last thing that anyone wanted to see was a renewed border going across Southern Ireland versus Northern Ireland, as a result of which was this Northern Ireland Protocol, which kind of meant that there would be checks on the UK side over goods and services going between the UK mainland and going into Northern Ireland. Now the UK government's come out and said, well, look, we don't like this, because essentially it means we're losing some control over what will be our internal market once we get to the end of this year and the EU transition period has ended. So basically, Boris Johnson is saying we want to have total control of what's happening to the UK market. And
so that means moving up the border.
The question is, what happens to the border? I mean, because the thing is, what's going to happen? Effectively, saying that the kind of checks they're supposed to be putting on goods coming into the UK, or indeed from UK going into Northern Ireland, isn't going to be there. So as far as the EU's concerned, its single market now has got a big hole in it, which is going to be driven through by whoever, because it's no longer a closed market because there's no official boundary. So the EU is hugely cheesed off, let's say, about this. But not only that, the key question, the broader issue, is that by effectively having signed the withdrawal treaty and now saying they want to change it, the UK is breaking international law.
Well, it's also good, to negotiate with someone who doesn't, who turns around and then does something else.
Well, this is it, because as folks I'm sure will remember, last week we saw the conclusion of the 8th official round of EU-UK trade talks about the future of a trading relationship between the EU and the UK once we get to the end of this transition period at the end of this year. Now, while this is still taking place, and it seems as if both sides have kind of given themselves a deadline now of around about the middle of October, if this thing is going to be agreed and ratified in time for the end of 2020. These talks are still ongoing, and now you've got Boris Johnson's effectively saying, oh, by the way, we're not actually want to stick to the agreement we had when we left the EU in the first place. So it's going to be a protracted period of, well, to start with, of battles, I suspect, within UK Parliament. Now, yesterday in the House of Commons, his new bill, this IBM bill, received the backing of 340 votes against 263 who voted against. So it sounds a pretty easy passage.
That was about his election.
He's got, well, strictly speaking, he's got an 80-seat majority. So normally you would think he could push through whatever legislation he wants. However, an increasingly large number of senior Conservative MPs, as well as a lot of the rank and file, have made it patently obvious that they are scared stiff about what this could do to the UK's international standing, reputation, and everything else. So he's got the first reading through, but if you like, that's the easy bit. What will happen now will be that I suspect there'll be various amendments that worried MPs will try to attach to this original bill in such a way that ostensibly, I won't say it's not worth the paper it's written on, but it'll get rid of all the big concerns about undermining international law. You can bet your bottom dollar or pound for whatever it's worth these days that when it goes to the House of Lords, they're going to throw it out. They are scared stiff about some of the implications of this, what it's going to mean for the UK standing internationally. So I think we're kind of in almost back to where we were a year or so ago, when it was all about, is it going to be a hard Brexit or a soft Brexit? And the pound would go up, down according. And what we're going to see now, I think, is a similar sort of thing. If it looks like this bill is going to go through as it stands at the moment, international investors are going to be none too impressed.
What's the name of the bill?
It's called the internal market bill, so IBM for short. Now, it should be said, one of the near-term sort of dates for the diary, so to speak, is that the EU's initial response is, well, clearly they're furious about the whole thing, but they've said, right, we'll give the UK until the end of this month to withdraw the bill, or they're going to take us to international court.
Well, how long could that drag on?
I have no idea. Anything like that can go on for an awfully long time.
The pullout date's the end of the year, isn't it? When is the pullout?
Well, the deadline for currently the UK is operating in they call this transition period, which to all intents and purposes means that we're still operating under EU rules while the UK extracts itself properly from the European Union.
And
sorry?
There's no stated deadline?
Well, the deadline for the transition period is the end of this year. So as of 1st of January next year, and Johnson has refused to ask for an extension of a transition period. So unless something happens, as of the 1st of January, 2021, the UK will be out on its own, either with a trade deal, if they somehow manage to agree one, or without one, which should be extremely bad for the UK economy. It'd also be extremely bad for the Eurozone economy as well. But that's the way it would be.
Oh, I have a question. You had mentioned that, and it's going to, betray my lack of proper knowledge, but the House of Lords actually wields power. It's not some kind of a ceremonial rubber stamp of some kind.
It's the second house in the UK. It's the House of Commons which does the bulk of the work, but the major bills in the House of Commons get passed across to the House of Lords for their approval. Now, what can happen is that the House of Lords, for whatever reason, don't like it, and they send it back to the Commons to be redrawn, amended, wherever it may be. In practice, under normal times, any changes tend to be pretty small, and it's really neither here nor there. But there are occasions, and this could be one, where the suggested amendments from the Lords will be vast, and the government won't be happy about it. So there could be a potential protracted period of toing and froing between the two houses before anything actually happens.
So let me just, it's a little bit of a digression, of course, but so the House of Lords, is this an ancestral element from the nobility? And
it kind of is, yes, although there's new lords who are named every year by the incumbent government.
And the government appoints, and do you have to be, have a title or
you will receive
property or?
You will receive a title if you become a member of the House of Lords. So, for example, you'll quite often get heads of British industry who'll be given a peerage. So instead of being Mr. Jones, you'll become Lord Jones. And
what about something like the head of the Salvation Army or something like that?
Unlikely, but this is something which has been sort of a major sort of battle area between, I won't say the right and the left, but say the more traditional Tory voters and the more traditional Labour or certainly left of centre voters as to why this particular group of society should be given, if you like, an additional say on top of what the people are saying who are represented in the House of Commons. So there's been various periods when talk arises about either the abolition of the House of Lords or greatly reducing the power of the House of Lords. And at some point, it does seem as time goes forward, it will change. But for the moment, at least, the Lords still carry a certain amount of power.
Wow. Thank you for that. That was
So
interesting.
it's going to be very, very interesting, because quite simply, when news of this first came out, I think we just touched on it because it's breaking news on the last podcast, most people simply couldn't believe it. And I think, a lot of people think, oh, this is just politicking. This is Boris Johnson pushing, using the last chance he has to try and convince the European Union that if they don't come out with a good trade deal, he's going to go down this route. But if it is, it's brinkmanship at the extreme.
Mhm.
All right. Okay. Well, I think we've probably been prattling on for far too long. So we will end it there. I say, do keep an eye on sterling, because if you're looking for a volatile currency at the moment, then the not so good pound is probably the one to pick. Okay. So from Mark and myself, thanks as always for listening. We'll be back next week. But before then, do remember to keep up to date with all the key market moving data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.